Jeffrey Sparshott is joining us from Washington right now to tell us about this. Jeffrey, give us the details.
Well, basically, as you say, it is fairly good news. The Treasury Department stepped in. They bought some assets at a time when no one else wanted them. They helped stabilize the market for mortgage-backed securities. And as the market came back, they sold them, and they made some money. That's only one small component of the larger bailout,
right,
which is still going to cost taxpayers money. But this one part is fairly good.
You're spoiling the fun. You mean there's actually some bad sides for all this as well?
Well, if you look at the overall bailout,
okay,
the piece of legislation that gave Treasury the ability to buy these mortgage-backed securities also put Fannie Mae and Freddie Mac into conservatorship. And to date, that's cost taxpayers $151 billion.
Yeah, no, exactly. Fannie and Freddie seem to be the big forgotten element of all this, or hardly forgotten, but people tend to ignore it when they're looking at the way things are priced out. Now, but is there anything that this can tell us about the performance of the housing market? I mean, clearly there's been a pickup in the value of these mortgages, and we had a separate story today about Fannie and Freddie and the prospect that they may be now looking to unload bulk amounts of mortgages off to Wall Street, who would own the houses and then rent them out. All of this is sort of talking about finding a bottom, it seems to me, in the market. Is that something we can read from this and that story?
I wouldn't read too much into this particular sale. These are actually pretty good assets. They have a government guarantee, and they have slightly better yields than treasuries. So in speaking with one analyst, he said basically you have the same risk profile as a treasury with a slightly better return. So why wouldn't the private sector want something like this? Okay. So I don't know if it so much reflects the housing market, is just investors' realization that this was something they wanted to have in their portfolio.
Right, but to be fair, I suppose this was something nobody wanted to have a few years ago, and now they clearly do. So we've had some pickup in sentiment, at least. Is this all of it?
Definitely.
Is this all of it in terms of that separate block of mortgages, or is there more to be sold?
Well, this is it for Treasury. Treasury is done. I mean, the big question next is the Fed. I mean, they have no plans to sell their MBS portfolio anytime soon, and in fact, late last year, I think in September, they started Operation Twist, where they started reinvesting the proceeds from their MBS portfolio back into mortgage-backed securities.
We're talking about $1 trillion there, right?
I think it's up around $850 billion right now.
Yeah, and that's, of course, just to point out, of course, the complications there is that if the Fed starts selling that, it's actually absorbing money back out of the system and creates all sorts of complications for its management of money supply.
The Fed would definitely have a bigger impact on the market than Treasury with their disposal.
Right, right. But what does this do to the bottom line for the taxpayer?
It's better. I mean, it's still going to cost.
Yeah.
But it's better than a lot of people had hoped at the time when these programs were passed.